it doesn't take brains, it takes temperament.
You don't need to be a genius to be successful in investing. The strategy that brought Warren Buffett $100 billion can be explained in 7 simple rules that anyone can follow. The king of value investing will explain each of them in detail in this video.
This is something that goes with your philosophy today. Get out of cash and get into assets, because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment.
Yes.
I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. On the other hand, you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash.
It is a hedge against the dollar?
Well, you can say all assets are a hedge against the dollar.
Right.
I mean, but all you know is that the dollar is going to be worth less 10, 20, 30 years from now. I say worth less, not worthless.
Right.
You want to watch that. But right. it will be, and that's true of almost every currency that I can think of. The question is how much it depreciates in value. But cash is not a place to that.
The concept that you need to put your savings in the bank and they will grow is a huge delusion. Bank interest is not even capable of offsetting inflation. While governments are printing money out of thin air like crazy, the purchasing power of currencies is catastrophically decreasing. So the only way out is to invest in assets that will preserve and multiply your money.
The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time. And those are the assets that appeal to me and Charlie. Now, there's some logical follow-on to that. If you buy that farm and you really think about how many bushels of corn, how many bushels of soybeans will it produce, how much do I have to pay the tenant farmer, how much do I have to pay in taxes and so on, you can make a rational calculation, and the success of that investment will be determined in your own mind by whether it meets your expectations as to what it delivers. Logically, you should not care whether you get a quote on that farm a day later or a week later or a month later or a year later. We feel the same way about businesses. When we buy ISCAR or we buy Lubrizol or whatever, we don't run around getting a quote on it every week and say, is it up or down or anything like that. We look to the business. We feel the same way about securities. When we buy a marketable security, we don't care if the stock exchange closes for a few years. So when we look at Berkshire, we are looking at what we think can be delivered from the productive assets that we own and how we can utilize that capital in acquiring more productive assets.
In that same interview, Buffett provided a telling example. Let's say you managed to get hold of all the gold in the world. You could have a huge gold cube. You could climb on it, admire it, polish it, and feel yourself the king of the world. But at the same time, that cube brings you nothing. And the only thing you have to hope for is that a year from now, or maybe 5 years from now, someone will offer you more to own that cube. When you buy an asset that produces nothing, you are simply betting that someone will be willing to pay you more for it in time will come along.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean, understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint, the Spearmint, and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business.
The Oracle of Omaha is trying to warn against investing in companies that you don't understand and whose future prospects you can't predict. even if shares of these companies seem cheap to you.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, and stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
It is very important to define your competence range and stay within its boundaries, as Buffett says. If you start experimenting outside of it, you will eventually fail.
But you can't keep always trying. For the average person who's maybe never bought a stock before, what's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for, how much do we think it's worth. When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
A legendary investor often repeats that he's not buying a stock, but a piece of a business. Therefore, the main thing you should learn is how to value a business. A good example would be Berkshire's investment in Apple. After analyzing Jobs' brainchild, Buffett realized that Apple had what it took to continue generating and growing cash flow. At the same time, the company itself was undervalued. The Berkshire CEO started adding Apple to his portfolio since Q1 2016, and he made no mistake. Since then, the market capitalization of Apple has grown 4 times, and free cash flow has grown from $53 billion to $111 billion per year. Analyzing companies and waiting for the share price of fundamental companies to reach a fair level is Buffett's investment strategy.
But the biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come.
With these words, Buffett urges us to be proactive. Everyone has heard his legendary quote about starting to be greedy in the market when others feel fear. You need to understand that drops in individual stocks and the entire market offer great opportunities that should definitely be capitalized on. Just realize how rare the events that are unfolding right now in the US, European and global economies are. Will you be able to take advantage of it?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you $15,000, you don't sell it because the quote's $15,000. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become.
Buffett keeps repeating that when the market crashes, you should never panic and sell off shares of good companies. Most people are guided by completely wrong logic. Don't be like that. Get rid of a stock only if the drop in its price is caused by a factor that will permanently reduce the business's ability to generate cash flow in the future. But if it's a great company and its decline is caused by external factors, don't give in to the crowd instinct. In the long run, all these market crashes will seem like only minor corrections. This brings us to the last, but perhaps the most important piece of advice.
If If you take the 20th century, it was an unbelievable century for the United States, terrifically. If you take the whole 100 years, it went up 180 for one. Every $1,000 became 180,000. The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding. But that makes for huge opportunity. Just huge opportunity. You will see things you won't believe in your lifetime. And securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains, it takes temperament.
Buffett insists that it's not the brain that matters in the stock market, but controlling emotions. You have to be the kind of person who doesn't care about next week or next month. Buying stocks of great companies and holding them for long periods of time is the best investment strategy. A legendary investor has given you 7 tips that if you apply, you'll have a great chance of making a huge profit. Thanks to everyone who supports our channel with likes and subscriptions. And don't forget about our other videos.